right, welcome to class, students. Our last class was or talk about IES 32, the issuer standard, talking about the presentation of financial instruments. We were able to solve a question that aided us in knowing how to classify or how to separate equity elements and liability elements whenever they are in the same financial instrument. And I call those kind of financial instruments a compound financial instrument. In this particular class, we'll be looking at IFRS 9 because that is the ruling standard. So we don't make reference to IAS 39 again. So we are making reference to IFRS 9. Please note that. And we all know we have treated, actually, so there's no need to make repetition. We have treated the initial recognition. We have spoken about the recognition, that once an entity should recognize the financial asset when the contractual rights to the cash flow from the financial asset has expired. Then we also know that if it transfers substantially all the risk and rewards of ownership of the financial assets to another party, so then you have to recognize such as an entity should also recognize the financial liability when it is extinguished. That's what do I mean by it being extinguished? Let me write it. Extinguished. I know you are not new to this. I'm just trying to refresh our brain. Extinguished. That is what I'm trying to say there is that when the obligation specified in the contract is already discharged, or probably is cancelled, or it could also be expired, or it can expire. Do you get? So that is what I mean by extinguish. Now, in IFRS 9, we spoke about different classification. We have three classifications, like IAS 39 that classified financial assets under 4, that is available for sale. Sorry, I'm making reference to this, to IAS 39. We spoke about available for sale. We said financial instruments held for trading. We also spoke about the held to maturity, and we also spoke about the loan and receivables. The loan and receivable is just for financial instruments that are not quoted on a stock exchange market. Most loans are not quoted on any stock exchange market or receivables, but they are usually measured and at amortized cost. That, just like the available held to maturity. Also, an example of this could be our redeemable loan notes. Do you get? So it is held to maturity, then it should be measured using the amortized cost. Those that are held for trading, of course, to pass through the P&L, and that is what IFRS 9 now converted to mean fair value, financial assets at fair value through the profit or loss. Do you see? So that is what, can you see the difference between IFRS 9 and IFRS 39? Now, those that relate to available for sales, do you get? They actually considered the basis for classification of financial assets under IAS 9. I mean IFRS 9 rather. It's not easy to be saying IFRS, IFRS, do you get? And actually have slip of tongues. So the basis was the business model. I said this, the business model for managing the financial asset, and we also have the contractual cash flow characteristic of the financial asset. So they considered it in. We have done all of this, so I'm just trying to refresh our memory. Now let's take this question. It's a question under financial assets. Do you get? So we are going to look at various questions that will point us to financial asset at amortized cost, true profit or loss, at fair value. Do you get? Just for us to have a practical knowledge, let's put what we have learned to use. Are we making any sense at all? So let's consider this question. On 1st January 2012, I think this question is on financial assets measured at fair value through the profit or loss. IFRS now told us now we have three classifications: financial assets at fair value through profit or loss, fair value through other comprehensive income, and we also have amortized costs. Do you get? If I want to group this, you see that I will group loan note and receivables. Then I also have available held to maturity under amortized cost. Then trading, held for trade for trading, will be under fair value through profit or loss. Then we also have available for sale will be under fair value through other comprehensive income, because if you remember, then for available for sale assets, we used to recognize their gain in the comprehensive income, and it is accumulated in a separate equity reserve. If you remember, that's if you remember. I'm just trying to give you comparisons between little things that changed. And if you look at itself, categories of financial liability in IAS 39 did not change with what was in IFRS 9. So can you see? So classification of, in just the differences, in IAS 39 they were using categories. In IFRS 9 they were referring it to as classification. Can you see what they are saying there? And in IAS 39 they said you can measure financial liabilities into two categories. That's financial liabilities at fair value through profit or loss, and financial liabilities measured at amortized cost. And what is IFRS 9 also saying? IFRS 9 is also saying similar thing. On recognition, IFRS 9 requires the financial liability to be classified as measured, classified and measured either at fair value through profit or loss or at amortized cost. Listen. So they also further said something that a financial liability is classified as fair value through profit or loss. That is if it meets certain criteria. One, if it is held for trading. Why are they making reference to held for trading in IAS 39? So can you see these things are actually very close. So that's why I say you cannot throw IAS 39 because of you are actually dealing with IFRS 9. Whenever I teach financial instruments in class, I teach IAS 39, I teach IFRS 9. But what I do, the reason why I teach IAS 39 is so that students will be able to understand IFRS 9 when we get there, because it eases your landing. It gives a soft landing to IFRS 9 whenever you get there. There are some things that you will not just be hearing again. Imagine hearing held for trading now. You are used to it, unlike you just hearing held for trading in IFRS 9. Because you have known held for trading in IAS 39, so it's not new to you anymore. Are we making any sense at all? So that being said, I want us to quickly, I'm talking too much, and it's not like I'm talking too much, I'm just trying to refresh our brain. So on 1st January 2012, an entity acquired 500,000 naira equity shares for 2.50 naira 50 kobo, yeah, and which will be held for trading. That is just all what we need. They've given it away. By them saying it will be held for trading, they've given it away. They don't have anything to hide again. Can you see? They don't have anything to hide again, so they've given it away. Now, look at. Sorry. I want to outline somewhere so that you will know. Will be held for trading. Okay, and pays issue cost. Now, I want to say something quickly. You know, when we spoke about initial measurements in IAS 39, they said initial measurements in IAS 39 that I'm coming. I want to quickly make reference to IAS 39. They said that initial measurements in IAS 39 that financial instruments are initially measured at the fair value of the consideration given or received. You know, that's the cost, literally the cost. Then plus or minus. You know, when you say plus, you are capitalizing it. If you say minus, that means that you are deducting it. That's in the case of a financial liability. In the case of a financial asset, you will add issue costs, do you get, or transaction costs that are directly attributable to the acquisition, do you get, or issue of the financial instrument. So if you are issuing, are we together? If it's a financial asset, if it's a financial asset and you have incurred some particular costs that are directly attributable to the acquisition or the issue, do you get? Then you have to capitalize it. But if it is for a financial liability, you have to deduct it. But the standard made an exception to this. Now, the standard said something. It said that if it is a financial instrument that is held for trading, that is a financial instrument that is measured at fair value through the profit or loss, please do not capitalize issue or transaction cost. Expense it immediately. Any financial instrument that is measured at fair value through the profit or loss, please note that transaction cost should not be capitalized, but it is written off as an expense in the P or L. Are we together? So please note that. Please note that. Now, we've been able to look at the financial, the initial measurement. Don't forget that initial measurement also for financial asset, according to IFRS 39, is not changed. For they said I should measure that fair value where you recognize the gain in the statement of profit or loss. That's for financial asset at fair value through profit or loss. For financial assets, sorry, I'm making reference to this a lot because I don't want us to just treat questions without discussing or breaking down some of these basic things. It's very essential for us to understand this before we say we can treat questions. So because of in this question, now if I'm solving it, you will see that I will not capitalize the trading, the issue cost rather. Do you get? Now, I had quickly made mention of IAS 39 because of I want to go and tell you what is happening in IFRS 9 also. Do you get? So, subsequent measurements, all of these things remain the same. Amortized cost for L to maturity, amortized cost for loan and receivables, then available for sale. For subsequent measurements, you are going to be through the OCI. You recognize the gain or loss in the other comprehensive income, and you accumulate in the separate equity reserve. Are we making sense at all? The same thing is applicable to financial liability. When we say financial liability that are measured through profit or loss, on their subsequent measurements, their gain or loss should be recognized in the statement of profit or loss also. When we have liabilities that are measured at amortized cost, then their subsequent measurements will also be at amortized cost. Are we making any sense at all? Good. Now back to IFRS 9. It is very important to consider the business model and also the cash flow characteristic of the financial instrument. Are we making any sense at all? So let's quickly and please, IAS 39 did not talk about equity instruments, but IFRS 9 said some things about equity instruments. Let me quickly talk about that. I know we have done all of that. Now, IFRS 9 said something that after initial recognition, equity instruments are measured at either fair value through profit or loss or fair value through other comprehensive income. Please note that if equity instruments are held at fair value through the profit or loss, no transaction costs are included in the carrying amount. So you are going to expense it. You are not going to, except if that equity instrument is measured at fair value through other comprehensive income. But if it is measured at fair value through profit or loss, no transaction cost or issue cost should be included in the carrying amount. It's literally telling you that you should not capitalize it. Let's quickly solve this question. Now, which will be held for trading and payment and pays issue cost of 20,000. On 31st December 2012, the market price of the shares was 2.70. I don't like as I'm referring it to as 2.0. You have to be professional about it. 2 naira 70 kobo. On 1st April 2013, the entity sold all the shares notes. We are required to show the accounting treatment of the above transaction. Fine. Now you've been able to know that this particular financial instrument is at what you used to know if it is a financial asset or a financial liabilities. You look at the entity. If the entity issued, do you get, or they acquired, pay attention to the word used, acquired, do you get, equity shares for 2 point, which will be held for trading, do you get? So they are actually holding it for trading. Have you seen? So it's actually pointing to something that, oh, it is the entity that is actually acquiring. They acquired it, they got it. It's not like they are actually how would I put it? They are acquiring it. Do you get what I'm trying to say? So it is held for trading and pays. They paid issue cost of 20,000. So they got people subscribe to their shares. Do you get? So they got 500,000 from the issuing of those shares. Do you get? Now, On initial measurement is a financial asset, isn't it? Yes, it's a financial asset now. Isn't it not a financial asset? So it is because of the acquired 500,000. Do you get 500,000 equity shares? They are actually another entity, is a financial is a financial asset to them. Do you get? Meanwhile, to another entity, it will be seen as an equity instrument. Do you get? So they just actually acquired that particular. I don't know how to explain it again. So let's quickly solve the question. Initial measurements. On initial measurements, so I don't joke with my journal or my ledger. Very, very important. Financial assets. Financial assets. Now, what will be the financial assets? That will be, let's punch our calculator. 2.50 as 500,000. That's 2.50 times 500,000. That's the financial asset that we got. That's 2.50 kobo times 500,000. That's the number of shares that we got. So to give you 1,250,000. So P or L, the incurred issue cost, which we have been told to capitalize, right? Sorry, we are not capitalizing it anyways. Pay attention to this. I just saw something now. Will be held for trading, so we are not capitalizing it. We are going to expense it to P or L. So that's 20,000. That's why I wrote P or L. So cash, we have paid cash. So total cost that we incurred was we acquired this for 1,250,000. Then with P or L, because of it's held for trading, 20,000. Usually derivative instruments are held for trading. So we released total cash that we released was 1,270,000. I don't know if we are making any sense at all. Which will be credited, because of cash is leaving us, so we are crediting cash. Are we making any sense at all? So now let's continue. That's on initial measurement. That's the first measurement on initial measurement. Now on subsequent measurement. Now we have been told that we measure that fair value through profit or loss, isn't it? We recognize the gain or loss in the profit or loss. Do you get? So let's go and check the question just to be sure of what happened on subsequent measurement. They said something. They said that December 2012, the market price of the shares was now 2.70, 2 naira 70 kobo. So there's a gain, isn't it? So just how do we do that? We say 2.70 times 500, right? That's 1,350,000. And before it was 1,250,000. So we now minus. Coming. So 1,350,000 minus. I'm not showing this here. Let me just quickly show it. I just solved it on my calculator. So that will be 2.70 times 500,000 shares. That will give us 1,350,000. So now say minus 1,250,000. So there's a gain, and we are going to recognize that gain in the profit or loss. Do you get? So there's an increase in financial assets. The financial asset is now 1,000,003. For every debit entry, there will be a corresponding credit entry. So the financial asset has increased by, it's just the gain or loss that will be doing, you get. So financial asset has increased by 100,000. So we credit it. It's meant to be an income, right? Because of it is held for trading, the gain or loss will pass through the profit or loss. So that's a P or L. So that's 100,000. I don't know if you are getting all what we are doing. 100,000. Now, don't forget that they said something that on 1st April 2013, the entity sold all the shares notes. Wow. So we have to recognize it, right? We have to recognize it. You still remember the recognition criteria? So let's now call this the recognition. So if they tell you to show the transaction you get that should be used to account for that financial instrument, know that if they've actually sold it, then you have to go for the recognition. If the measurements changed after the initial measurements, you have to do subsequent measurements. Then of course normally you usually do, in as much as you recognize it that is a financial instrument, you need to quickly do initial measurement. And please pay attention to the kind of English that is used. If they say they issued, do you get, that means that they are trying to, is a financial liability on their own part. Do you get? When they are issuing, people are giving them cash, so that cash will be seen as a financial, depending on how it might be anyways. Do you get? If it is, you know that financial instrument is a particular transaction that gives rise to financial asset or liability, financial assets on one entity, and also gives rise to financial liability or equity on the other entity. Do you get? So of course, as it is financial asset here, it's either it's financial liability of equity in another entity. Do you get? So that's what I'm trying to say, that in the entity that they are acquiring this from, the shares from, they will be seen as an equity holder, and not as a liability. As it will not be a financial liability, then it will be seen as equity. Do you get? So that's that with respect to that. So if you are looking at the English, what will make you know if it is a financial asset? I was saying that our financial liability. Be paying attention to did he acquire? Do you get? Or is he issuing? If he's acquiring, that means that he's actually purchasing their assets, their shares. Do you get? And they are the one that is receiving the payment, so it will be seen as an equity on them. I didn't mean that he's one subscribing to their loan, to be seen as a liability on them. Do you get? So, and if he's the one issuing that equity, it will be seen as an equity instrument. It will be seen as an equity instrument on their own part. Meanwhile, on the part of those that are buying, it will be seen as a financial asset. Meanwhile, if it were to be a loan stock that they were issuing, it will be seen as a financial liability on them. And to the entity, other entity, to be seen as a financial asset. I don't know if what I've just summarized now made any sense to you. So the recognition. Now, the recognition. Let's go back to the question. They said something that on 1st April 2013, the entity sold all the shares notes, everything. So we have to recognize it. Are we together? Okay, so there was a mistake on the question. So the way it has been corrected though. On 1st April 2013, the entity sold all the shares for 3 naira per share notes. 3 naira per share notes. So how to recognize financial instruments. That's financial assets. We have recognized it before, so we have to recognize it now. So we received cash, isn't it? By selling it, we'll receive cash now. We're not going to receive cash. So cash of 500,000 times 3 naira. That'll give you 1,500,000. So we have financial assets. How much was the financial asset valued as at then? We have to recognize it was valued as 1,350,000. So don't forget that there's a cash, there's a gain on the disposal of 150. It was valued at it was valued at 1,350,000, and they sold it at 1,500,000. So we have to recognize a gain of 150 and pass through the P or L. Why did I write cash again? I should be writing P or L now, not cash. It's not 100. So it's passed through the P or L. That's how much? 150,000. So that's that as regards this. When next we come back, we'll look at another question, practical question that will aid our understanding. So thank you and see you in class. Bye.